Welcome to the Skilled MBA Finance Case Study Series, where we explore real-world decisions that shape corporate financial strategy. It's August 2024 in Mumbai. Harsha Desai, an equity research analyst, notices something striking. Berger Paints' debt-to-equity ratio is a mere 0.021. This exceptionally conservative capital structure prompts a pivotal question. Is Berger Paints under-leveraged? Could the company be missing out on creating additional shareholder value by not utilizing debt optimally? A deeper dive into this low gearing reveals both strengths and constraints. On one hand, the firm demonstrates remarkable financial prudence and low risk. On the other, it may be foregoing opportunities to enhance return on equity through leverage or fund expansion more aggressively. This case raises important strategic questions. Should Berger Paints consider rebalancing its capital mix to optimize cost of capital? What would be the implications for investors, growth, and financial flexibility? In Mumbai, August 2024, Harsha Desai, an equity research analyst, observes Berger Paints' notably low debt-to-equity ratio of 0.021. This raises a critical question. Is Berger Paints missing out on potential shareholder value due to its current capital structure? Berger Paints, founded in 1923, is a key player in the Indian paint industry, with over a century of experience. As the second-largest decorative paint company, it operates 17 manufacturing facilities, ensuring extensive market reach. The company benefits from stable industry dynamics, characterized by consistent growth and predictable demand cycles. The Indian paint industry, valued at 70,000 crore rupees, is poised for a 10 to 12% compound annual growth rate, fueled by urbanization and rising per capita consumption. Decorative paints dominate with 75% market share, propelled by housing growth. Industrial paints account for 15%, linked to manufacturing. Automotive paints hold 7%, while other segments, including marine and protective coatings, comprise 3%. Berger's debt-to-equity ratio stands at 0.021, much lower than the industry average of 0.15 to 0.25, reflecting a conservative financial approach. By exploring moderate debt levels, Berger could optimize its weighted average cost of capital, WACC, and potentially enhance shareholder value. Berger Paints shows robust financial health with consistent revenue growth and strong earnings before interest, taxes, depreciation, and amortization margins. This indicates a potential for increased financial leverage, aligning with the conservative debt-to-equity ratio. Leveraging this capacity could optimize capital structure, enhancing shareholder value while maintaining financial stability. Berger Paints' capital structure shows total equity at 5,460 crore rupees and total debt at 115 crore rupees, with cash reserves of 620 crore rupees, resulting in a net debt of minus 505 crore rupees. The debt-to-equity ratio is 0.021, and the interest coverage ratio is 48.3 times. Harsha's analysis indicates Berger is under-leveraged compared to industry benchmarks, reflecting a conservative financial strategy. Capital structure optimization involves balancing tax benefits of debt with financial distress costs, as per trade-off theory. Pecking order. Theory suggests firms prioritize internal financing, then debt and equity last. Signaling theory indicates capital structure choices signal market prospects. The Million theorem posits capital structure irrelevance in perfect markets, but real-world imperfections create optimal leverage points. Harsha's analysis indicates that optimizing the debt-to-equity ratio can enhance enterprise value by up to 17%, assuming constant business risk. This sensitivity analysis highlights the impact of leverage on the weighted average cost of capital, WACC, and its subsequent effect on enterprise valuation. The current cost of equity is 12.5%, derived from the capital asset pricing model with a 6.5% market risk premium, a 7.2% risk-free rate, and a beta of 0.82. The potential pre-tax cost of debt is 7.8%, based on AA-rated corporate bond yields. After tax, this cost reduces to 5.9%, considering a 25% corporate tax rate. The current weighted average cost of capital stands at 11.2%. Exploring Berger's capital structure, the status quo with a 0.02 debt-to-equity ratio yields an 11.2% weighted average cost of capital. A conservative debt approach at 0.20 debt-to-equity reduces weighted average cost of capital to 10.4%, enhancing value by 9.5%. Moderate debt at 0.40 debt-to-equity optimizes weighted average cost of capital at 9.9%, increasing value by 16.1%. Aggressive debt at 0.60 debt-to-equity maintains weighted average cost of capital but introduces financial distress risks. Indian paint manufacturers typically have lower leverage compared to global peers. Berger Paints stands out with an even more conservative capital structure, emphasizing financial stability. This cautious approach minimizes risk but may limit aggressive growth opportunities, contrasting with global trends where higher leverage often supports expansion and innovation. Exploring strategic growth, increased debt capacity can drive expansion into Tier 2/3 cities and boost product innovation. Significant capital expenditure is needed for new manufacturing facilities and automation over the next 3 to 5 years. Additionally, debt financing could facilitate strategic acquisitions of regional players or complementary businesses, enhancing market position and competitive edge. Finance professionals should optimize leverage by balancing tax benefits with financial distress costs. Dynamic capital structure assumptions enhance discounted cash flow valuation models. Recognize value creation opportunities through financial engineering. Evaluate leverage against sector-specific risks, ensuring alignment with long-term business objectives. For finance professionals, leveraging optimization involves identifying the balance between tax benefits and financial distress costs. DCF valuation should incorporate dynamic capital structure assumptions. Recognizing opportunities for value creation through financial engineering is crucial. Evaluate leverage against sector-specific risks and ensure strategic alignment with long-term business objectives. Thank you for watching this financial deep dive with Skilled MBA. For more real-world finance cases and strategic insights, connect with us at mobile +91-8 7553 00795 mail. support@skilledmba.com. Website www.skilledmba.com.